Picking a mortgage company can save you thousands of dollars or lose you thousands of dollars. And there's so many options out there, from banks, credit unions, online lenders, mortgage finance companies, alternate banks, private lenders. How do you even pick one? Well, today I'm going to help you to understand the 3 primary different types of mortgage lenders that are available to you. There will be many other options available, but my focus today is to make sure that you can understand when you're working with your mortgage professional, which lender makes the most sense for your specific situation, and of course, how to move going forward. And at the very end of this video, I'm going to summarize my recommended recipe to pick your top lender moving forward. Hi guys, it's Alex McFadden here, your mortgage and wealth expert. Now, you might be wondering what makes you a mortgage and wealth expert. Well, I've been fortunate to have been licensed since 2011 and worked in the industry helping over 3,500 families, and have established multiple systems to help my clients create wealth and understand opportunities to save money on interest in their mortgages. Let's get into it today. Your primary question is, how do I pick a mortgage lender now? With so many different lending options available in the marketplace, it can become really complicated for a lot of people. And what we're going to do today is we're going to break down some key categories and some different considerations so that you understand what to look for. Let's get started, shall we? First and foremost, generally speaking, most mortgage companies come in 3 types of flavors. One is a bank. Now, a bank could be one that you might know. There are 5 chartered banks in the country, or one that you don't, one of these smaller banks, which could be foreign, local, or otherwise. In either case scenario, banks typically receive deposits, lend money, also work with different types of products such as TFSAs, credit cards, RSPs, mutual funds, and other investments. Now, banks do have a lot of similarities in the types of products they offer. And so we're going to start off today by talking about what the pros and cons of working with a bank for your mortgage are. Let's get started, shall we? Number 1, with a typical bank mortgage, you'll note that most of these institutions think of a mortgage as, in most cases, a loss leader. What a loss leader is essentially is a type of product that they can get someone into a product for a certain cost, perhaps less than they might make otherwise, so that they can cross-sell different types of products. Well, what that means for you from a mortgage perspective is that at different times, they may or may not price more aggressively or effectively from a rate perspective. But generally speaking, what you'll find with most bank mortgages is that when they're having a sale, they'll be very aggressive, and when they're not, the exact opposite. There's not very much in the middle. Now, when it comes to the actual product itself, some advantages that banks carry that some other lenders do not are, number 1, they can typically provide you with more exceptions when it comes to the amount that you borrow, especially if you're putting down more than 20%. The banks have the ability to essentially underwrite your application to help you qualify for a greater loan amount by extending the amount of income on your application. And that's something that you might not see on a mortgage finance company. And in addition to that, often you won't see that with a credit union. So that's your first advantage, borrowing more money. And number 2, you'll find that banks offer a lot of different types of programs and scenarios that can help different people to qualify. The third, and kind of a bonus, is that almost every single bank will offer some form of a HELOC type product, which is a line of credit. And in many situations, they will also offer you something like what's called an advanceable mortgage. This is as you pay down the mortgage principal, you can borrow more money back from the line of credit. Now, that's not the case with all banks, so make sure that you keep in mind this is some banks that offer this product. Now, moving forward, what are some of the disadvantages with bank products? First and foremost, aftercare support. The reality is that most of the banks and the larger banks are focused more on getting different products from you than servicing your mortgage afterwards. So just be prepared that once you have your loan in place, you probably won't get the best support from your bank. And in many situations, the technology and the online support looks like it's from 2005. That's why, of course, you should always work with a good mortgage broker so they can provide you with the advice and support and help you to understand your product. And number 2, one of the other disadvantages of banks is they almost nearly always ask you to register what's called a collateral mortgage. Now, this can work for you if you're looking to add a home equity line of credit, but this will work against you if you're looking for the most aggressive rate options at the end of your term. If you have a collateral charge mortgage registered on your home, what this will mean is that if you decide to switch mortgages to another lender at the end of your term, it will actually cost you more money and you will not get access to the best rate options at that time. The third negative when it comes to working with an actual bank is just the challenges of haggling. Typically speaking, banks will never provide you with the best rates up front. And so there's a lot of haggling back and forth. Again, another reason that you want to work work with an independently licensed mortgage broker, but even at the end of the term, you'll never be offered anywhere close to a competitive option, and they may never do so. So it's important to remember that at the end of the day, these are profiting companies looking to borrow as much as possible, and just because they offered fair terms this time certainly doesn't mean they will next time. Again, that's why we're going to negotiate on your behalf. Now, there's some other pros and cons that come with banks. First and foremost is that in many situations, they'll give you the ability to have flexible prepayment terms. Another disadvantage is that if you exit the terms early, you can be hit by a massive penalty. We won't get into how penalties are calculated today, but we will tell you that generally speaking, the charter banks, if you were leaving a fixed rate loan in the middle of the term, have some of the most significant and highest prepayment penalties that you can pay in the marketplace, as much as 5, 6, or 7% of the outstanding balance, which is much higher than you would find with one of the monoline or mortgage finance companies. So when it comes to banks, pros, more product options and flexibility around how much you can borrow. Cons, the prepayment penalties, not fairness around the interest rates, and of course, lack of support. Let's move on to option number 2, credit unions. Now, credit unions can be great lenders in many circumstances. First of all, credit unions in many cases are local, so you could be supporting your local community. Now, this isn't always the case because there's provincial and national credit unions, but some people like to support their local community. The second consideration with credit unions is they typically have what we call common sense lending. And so because a lot of them are local, they will look at unique types of products, different types of land circumstances, and they tend to be a little bit more favorable around local businesses. Last but not least, one of the other pluses with credit unions is that they often will use a greater amount of rental income to help someone qualify for more money. And that's where things really are with credit unions. They tend to be more flexible about some areas. Where the drawbacks when credit unions come in is around the flexibility of the mortgage product itself. You'll find that credit unions typically will not allow you the capability to pay down your mortgage as fast whenever you'd like to. And in fact, most of them will actually ask you to only pay down a lump sum once per year on the anniversary date with a minimum of, say, $1,000. Again, this isn't a broad statement, but this is very common in the credit union marketplace. One of the other drawbacks, just like the banks, credit unions will also provide a collateral charge on your property, which means, again, at the end of the term, it will be a higher cost if you decide to transfer. And then last but not least, credit unions typically have a smaller size of staff, which can be great if you find the right timing and the right situation, but it can also work against you because they can often be very slow and offer slow support and service, which can be frustrating. Another reason that you want a mortgage broker as your advocate to make sure that you're getting the information and the timely responses that you're looking for. So credit unions on the scale, higher penalties, but greater flexibility when it comes to unique scenarios. They have a place. They're not always the most preferred option, but they are worth considering. All right, lender number 3. Mortgage finance companies, monoline lenders, internet companies, there's so many different names for them. Really, at the end of the day, what you need to know about a monoline or a mortgage finance company is that that's all they do, just simply mortgages. Just to name a few would be First National, MCAP, Merrick's Financial, among others. Some of the benefits of going with a mortgage finance company are the following. Number 1, they typically have much better aftercare support. Number 2, the online portals for access prepayments are more flexible. And number 3, if you're looking to pay down your mortgage faster, they typically also have some of the best terms available to prepay your mortgage at a later time. As far as interest rates are concerned, mortgage finance companies usually fit somewhere in the middle between the best rate offerings and the highest rate offerings, but they are typically very competitive. Why a lot of our clients tend to go this route is because they do offer lower prepayment penalties if you are to exit your term with a fixed rate loan. They have something that we call a fair mortgage penalty, which we'll talk about in another video. They have the ability to typically prepay your mortgage on any payment, which is more flexible. You have the ability to go online and make these changes. And at the end of your term, in most circumstances, a mortgage finance company will have registered your mortgage as a standard charge, which means you can move to another lender at a much more fair cost. This basically means when you get to the end of your term, whether it be 2, 3, 4, or 5 years, you can move over to another lender at fair rates. Now, some of the disadvantages of a monoline lender are that they typically don't have the flexibility to lend you more money or make different exceptions. They also don't typically have the best rental qualification guidelines. So if you're relying on rental income, they're usually not our go-to. But there are so many pros associated with them that they have to be considered a top lending option. With these 3 primary mortgage finance options, how do you even pick one? The first and most important thing is you always have to think about your long-term goals. Are you looking to grow your portfolio? Are you the type of person that would refinance in the middle of a term? Will you take advantage of prepayment functions? And last but not least, do you care about things like penalties, restrictions, and aftercare support. Once you decide on the impact of these different considerations, it will be a lot easier to focus in. And when you need help making a decision, remember to work with a mortgage broker, because we have access to not only the rates and the lender's best terms and options, but we can guide you in the right direction without charging you a fee. I hope you've enjoyed this video about different types of mortgage finance companies. If you have, make sure to drop a little comment below. Let us know who you would pick and who you wouldn't. Leave us a like and hit subscribe.